everyone. Welcome to Cigars and Syndication. I'm Robbie. I'm here with Jay, where we're passionate about real estate and passionate about cigars. Today, we're going to talk about accredited and non-accredited investors.
Welcome everybody. I'm Junaid Noor, and we'd love to have you on Cigars and Syndications. We're smoking a La Flor Dominica Oro. What is this? What is the shape called? It's called a
Chisel Tubo.
chisel tubo. This is a very good smoke. It draws very nicely, and I'm really enjoying this. But let's get into our topic: accredited investors versus non-accredited investors. And there's some changes coming on the horizon that the SEC is proposing in regards to accredited investors and non-accredited investors. But let's go ahead and let's start talking about what the differences are. So, for people who don't know, we can explain to them what the differences are.
So this is all governed by the SEC, and they have to review these positions every 4 years.
Yes.
And for accredited investors. And it's pretty straightforward. I mean, I think they're looking for, as an individual making 200,000 or more per year for 2 consecutive years and a reasonable expectation to hit those numbers again in the current year, or 300,000 with spouse. I guess also you can also qualify to be accredited, having 1 million in assets,
Net worth.
individually.
Net
Yeah,
worth.
in net worth, minus your home,
Yeah, minus your primary residence.
and that's either jointly or individually.
Yeah. So the whole idea of this was that the SEC wanted to make sure that people who are investing. So let's go back a little bit. Okay. So there are two groups of type, or there are two types of investors that we as promoters of certain assets can go after or can solicit.
Or not solicit.
Or not solicit. Right. You're right. And so the SEC basically says that if you bring investors, excuse me, if you bring in investors, you have to be registered with the SEC as a broker dealer. That means you have to have your stock selling license. I think it's called a Series 7. Or unless you fall under one of these exemptions. And so one of these exemptions is that you have what's called a 506B as in boy, or a 506C. And the 506C is basically accredited investors, and the 506B is non-accredited investors.
And as a sponsor or a syndicator, it's really important to how you get in touch with these investors, and the 506B versus the 506C. I mean, there's some pretty strict guidelines in how you accomplish your marketing and your fundraising.
Right. So the 506B, we'll start with that. The 506B is for non-accredited investors. And the reason the SEC gave that exemption was because if I have a property that I want to get investors for, maybe my mother wants to invest, maybe my brother wants to invest, aunts, uncles, people I know. These are not necessarily sophisticated investors, and they may not understand what kind of investment they're getting into, but because I have a personal relationship with them, I'm going to make sure that I take care of them, even if they don't understand, because they're family or they're close friends. And so therefore, the SEC provided this type of investment grade so that, as the promoter, as the sponsor of a real estate deal, I can get my close friends and families and people who I have a connection with involved, because the mere having that connection, I'm going to make sure that they are taken care of and they're not getting into a fraudulent deal or a bad deal.
Right, and I think as well, the 506B is extended to relationships that have exceeded 30 days. Whether it's through education or networking, you have an initial contact, and then you have a cooling off period before you can solicit or market them for deals.
Yeah, interestingly enough, the SEC doesn't really define the 30-day period. That's something that kind of industry has come with. Uh, um, Basically, they define it as you must establish a relationship with a person before they can invest with you. And mainly, this is for outside of the extended family, right? So somebody who is a non-accredited investor wants to invest with me. The SEC wants to know that as a sophisticated sponsor, somebody who understands the deal, I understand what they are capable of, whether they can invest or not, and um, they understand that I explain to them what they're getting into. So, for example, some of our deals are cash flow deals, some of them are not. Any development deals that we have, 2 or 3 years, there's not going to be any cash flow. So when we talk to 506B investors, we explain to them that, hey, look, we want to make sure that this is not all the, if you're investing $50,000, for example, this is not the only $50,000 you have in the world, because we don't want you to lose that. There is a chance that you may lose it. There's no cash flow. So that whole explanation process has to go on. And then the industry standard has kind of adopted a 30-day cooling off period, so that the person you spoke with has 30 days to kind of rethink it. You know, do I really want to get into this? This $50,000, all the money I have in the world, maybe I don't want to invest in this. And then after 30 days, we kind of consider that a relationship has been established.
So that's the 506B, and from a capital raiser side, sponsor, syndicator, um, you know, I think that explains a lot of these networking events that get held, a lot of these educational seminars and things that get held. They get you there, you register, it's dated, you've got an established relationship, and it makes it okay for them to market and solicit you. With the 506C, an accredited investor, I mean, you can immediately start presenting deals.
Right. So the difference that I forgot to point out was the marketing portion of it. On a 506B deal, you can only send it out, or you can only solicit those investors that you have a pre-existing relationship with. So we cannot openly put it up on Facebook, on social media, on LinkedIn, say, hey, we've got this deal. Um, but if it is a 506C exclusive deal, that means that you are only marketing to accredited investors. So those kind of investors, if the deal is only 506C, then you can market it openly with certain, you can't be like, oh, guaranteed cash, things like that. But you can market it openly, because the SEC assumes that the people who you are targeting have a net worth of $1 million, or they're making enough money that they have some sophistication in the financial field, and they kind of understand what they're already getting themselves into.
So you can, as a capital raiser, you can actually you can have a deal that's all 506C. You can have a deal that's all 506B, but you can also have a combination of both.
Right. If you get a combination of both, then the SEC limits it to 35 investors of 506B. And then they give you a period in which you cannot openly advertise. And then after that period, you can openly advertise, but you can no longer take any more 506B. And again, that is because, let's say I have a deal and I want to put all 506C, I want to make it a 506C deal for accredited investors only. And then my dad comes up to me and says, I want to invest in this deal. Well, Dad, you're not an accredited investor. So we go back to the SEC, and the SEC says, okay, you know what? If they're, you can do 35. You can put 35 of your family members in there, and that's it. And you have a quiet period in which you cannot advertise openly. Once that quiet period is over, 506B is done. Now you can advertise openly, but it's only 506C.
Do the type of deals favor one type of investor or another?
So usually 506B and 506C accredited investors can always step down and invest in a 506B deal, but 506B investors cannot go the other way. They cannot invest in a 506C deal. Uh, you know, I've seen it and I've heard it both ways. I've heard it where there are sponsors that will do nothing but 506C deals because it's easier for them. You're dealing with accredited investors. You can advertise openly, and you don't have to worry about going through your pipeline and talking to each investor and establishing relationships. And then I've seen it on the other end too, where uh, there are sponsors who like nothing but 506B as in boy deals, because their investors don't want to go through the paperwork that's involved with the 506C, right? So a CPA has to provide, or an attorney has to provide, or a third party accreditation site has to provide a letter certifying that you are accredited. And so there's some documentation process, and a lot of the five, and I've heard it both ways, right? That some of the 506C guys don't like doing that. They don't want to go through the documentation process.
I at least from my perspective or my experience, I've seen some of the 506C entry points. It's a little higher investment, typically in the 250,000 plus range, and then you get into the 506Bs, and I've seen a lower entry points.
Yeah, usually, I've seen 25 and $50,000 entry points for Bs. I've seen them for Cs too. But yes, typically the people with the higher net worth and the accredited investors are able to invest higher amounts.
Well, I know earlier we mentioned that every 4 years they take a look at it, and I think there's some rumors out there that they may make some change and have some inflation adjustments.
Yeah, there are some rumors out there that the SEC may propose uh, indexing the accreditation numbers for inflation. So basically, what that means is that if your net worth was $1 million and now they want to change it to maybe 1.5 million, and then if you were, making your income was $200,000 individual, $300,000 joint, maybe they make it 300,000 individual and 500 joint or 450 joint. But that basically says that if you were an accredited investor, with the new numbers, you might not be.
Man, I could see that creating some heartburn on some existing deals.
So, in addition to that, though, I guess I don't know if it's a good thing or a bad thing, and I'll get your thoughts on this. The Equal Opportunity for All Investors Act, which passed the House, but it hasn't passed the Senate yet. It would empower the SEC to create a qualification exam for persons who lack the income or net worth, but they possess the appropriate financial sophistication to qualify as accredited. So basically, they're saying that, you know what, we'll give you an exam, and if you can pass the exam because you have the financial acumen, but if you don't necessarily have the money, you can still qualify as an accredited investor. What do you think about that?
I think it's interesting, and I think that ultimately, I think if you have the ability to make these investments and maybe don't have the cash to qualify as an accredited investor, or maybe you recently have money to qualify as a accredited investor, but you don't have the 2 years or the $1 million net worth. Um, but you have you've passed this exam. I think why not? But I mean, it is a risk.
I mean, I'll play devil's advocate because I took the CPA exam and I studied to the exam. That was 1997. If I had to take the CPA exam right now, I would probably not do well. But people study to the exam. So, you're gonna have a whole industry of, you know, uh, investor act review, exam review, and they're gonna teach you how to pass the exam. But I think that the fundamental issue with the SEC requirements was that just because you've passed the exam, are you able to understand what the risks are of the investment you're making? And I don't know if passing an exam, it will necessarily qualify somebody to understand the risk.
Well, just like having $1 million or more net worth doesn't necessarily qualify you as an investor.
That's true. But on the flip side of that is that, well, if you're investing $100,000 and you got $1 million net worth, you're going to be like, okay, I lost $100,000, boo. You know, if you pass the exam and you have $50,000 net worth and you invest that 50,000 and you lose it, that's it. You don't have anything left. So, there's some pros and cons to this. And, on the one side, it is buyer beware. But on the other side, the government has taken some steps to make sure that people don't get scammed. because there's a lot of scams out there as well.
Yeah, no, it is. It's a. I think that's a slippery slope, and I really don't know what the right answer is. I don't want to say that you should exclude certain people from opportunities to make money, but at the same time, you know, they should proceed with caution. Everyone should.
I mean, the whole reason that the SEC was formed was, I believe it was the 1932 Securities Act, and this was after the 29 crash. And, as a result of the 29 crash was because, number one, there was a lot of free money out there. So you can borrow to buy stocks. Number two, there were a lot of companies out there that didn't really exist. They didn't really do anything, but shares were being floated, shares were being manipulated. And so, there was a lot of scams going on. And therefore, as a result, the SEC was formed so that any corporation that's going to float shares has to have, financial statements and has to be registered with the SEC. And, the laws have progressed dramatically over the last, few decades. But nevertheless, you still hear about financial scams. Balance sheets are being manipulated, income statements are being manipulated.
Yeah, no, I mean scams are very real, and they're very prevalent out there on very small scales and very big scales and large scales, and just not that many years ago, we had the whole Enron. I mean, we're talking about a scam on a global level.
Yeah, a multi-billion-dollar Enron scandal with where they're moving their liabilities to off-balance sheet companies, or they're selling them to these off-balance sheet companies, recognizing income, moving them between corporations, and there's no actual cash movement. And at some point, it has to come to a head. But again, it's all accounting and financial engineering that they were doing.
Well, I hope everybody had a good time on the episode. The Whether you're a 506B or a 506C, be happy and invest and grow your wealth and get to where you want to be in life. I think that as a syndicator and a sponsor, we're open to both B's and C's, and hope y'all enjoyed the episode.
Yeah, thank you for joining us. And just one more thing that I want to add. If anybody wants to learn more about the Enron scandal, there's a great book out there called The Smartest Guys in the Room. I highly recommend you pick it up, read it. It gives you a whole detailed account of what Enron was doing, how they were doing the financial engineering. So grab yourself a cigar, grab a good book, and make some money.